It's advisable to begin investing at a young age. Your money has more time to grow the earlier you start, which will put you on the path to financial freedom. Through prudent budgeting, investigating a variety of investment opportunities, and managing risk, students can establish a strong financial basis and gradually convert modest sums of money into substantial wealth. You can never start investing too early, since you have more time for your money to grow the earlier you start. Investing and saving early saves a lot less than waiting until later and having to make up lost ground, according to financial experts. Determine the amount of money you can invest. Establishing a budget is crucial if you don't already have a system in place for keeping track of your spending. Determine how much money you can make after taxes and how much money is left over after covering essential costs like food, rent, utilities, phone, and cable. Determine your spending limit for items such as entertainment, clothing, and outings. Next, reserve a portion of what's left over for savings. Some advises giving your emergency fund, which ought to cover about 6 months' worth of living expenditures, a top priority. You can start investing some of your savings after you have established a buffer. The amount of danger you're willing to take is one thing that you must determine. Certain investments have the potential to yield substantial profits, but they also carry a high risk of losing money. You might respond, "Yeah, I can take some risk. Let's act decisively," some said. However, what would you think about your $1,000 portfolio, perhaps falling to $400 as a result of that bold choice? Where to put your first money? The initial action. Which kind of account will you use to deposit your funds? With a brokerage account, you can purchase and sell stocks, bonds, mutual funds, ETFs, and other products without worrying about incurring penalties because it's a taxable account. These days, a lot of brokers have modest initial deposit requirements. Brokerage accounts are used by investors for both long-term and day trading, as well as for short-term savings towards financial objectives. You don't have to go it alone when starting because there are many programs available to assist you on your path, such as TD Ameritrade, Acorns, Betterment, Fidelity, Sophie, and Robinhood. Some let you choose your risk threshold, while others let you trade stocks, bonds, and mutual funds on an individual basis. Subsequently, your money is automatically invested in mutual funds that align with that. Thus, conduct some study, select one, try another one till you find what works best for you if you feel like it's not working for you or you're just interested. Investing cannot be done in a good or a wrong way. Recognize your available investing choices. We've used a lot of terminology, such as mutual funds, stocks, and bonds. Let's review some definition of basic investing strategies now. A savings plan. The simplest type of financial investment is a savings account, which lets you store money safely and receive interest. In certain accounts, the real rate of return on investment or annual percentage yield can exceed 0.50%. You can distinguish between money that's intended for future use and regular spending money that's stored in a checking account by opening a savings account. If the bank collapses, your money is protected up to $250,000 federal insurance policy for this kind of account. This is usually done at a bank. It might be the same bank where you have your checking account, but other people would rather bank their funds elsewhere. You may be able to compare rates and decide if it makes sense to use a different bank. That is, it will increase your income. Deposit certificate CDs. This kind of account is comparable to a savings account, except it has more money and a fixed interest rate for a set length of time. The catch is that you are locked in for a predetermined amount of time and are not allowed to access the money without paying a penalty cost. It's a terrific method to earn more money than you would with a regular savings account, but you need to make sure the money is something you won't need to leave in the account until the designated amount of time. 2 years, 3 years, whatever has passed. Funding for the money market. All the money market funds are thought to be very low risk. They do not yield a high rate of return despite producing income. However, they are a secure choice that will gradually increase your money. Hence, for protection, financial experts will frequently advise holding a portion of your portfolio, but not too much, in a money market fund. If you have $500 to invest, you may park it there first before beginning to transfer it to the other investment vehicles. Stocks. Purchasing stock is equivalent to buying a single share of a single corporation. Depending on how much stock they possess, a shareholder is entitled to a piece of the corporation's assets and income. Exchanges like the NASDAQ and the New York Stock Exchange are where most equities are bought and sold. However, you can buy them via a broker or an app. A bond, at its most basic, a loan made by an investor to a borrower, such as a particular corporation. The business pays for its needs with the money you lent it. Interest on the investment is paid to the investor in the interim. Bonds are essential to a well-balanced portfolio because they can lessen the impact of a fall in the stock market. Mutual investment vehicles. Mutual funds pool the capital of several investors and use it to buy stocks, bonds, and other assets. The term portfolio refers to the particular stocks, bonds, and other assets that money is invested in it. Anything from a sector like technology or healthcare to a risk level growth versus value or target date like 2030 can be used as a criterion for what should be included in the portfolio. A money manager oversees mutual funds, choosing and adjusting assets in the portfolio to aim to optimize returns for investors. There are fees associated with having an expert manage the investments. Exchange-traded funds, ETFs. ETFs are collections of assets, just like mutual funds, but whose purpose is to track a certain index, industry, commodity, or other assets. Thus, you may own an ETF that tracks real estate or corporate bonds. To give students access to hundreds of stocks without requiring them to conduct in-depth research on each one, Bombardier advises them to invest in inexpensive, well-diversified exchange-traded funds. Funds with indexes. Although an index fund is similar to a collection of assets, it's linked to a particular index, such as the NASDAQ or S&P 500. Because no expert spends time selecting stocks or bonds for funds, index funds have the advantage of often having cheaper costs. Because you put some money in it, can set up automatic recurring purchases, and have dividends automatically reinvested on their own. Hunt advises students to invest in index funds. Diversification is the key. Experts assert that diversification, having a range of interests in several industries, is the key. Avoid putting every one of your eggs in one basket. This maintains equilibrium. If one investment declines, another may increase or remain unchanged. Sun clarified that, for instance, if all of your investments are in technology and the industry starts to decline, your portfolio will also, for whatever reason, suffer. Your overall portfolio is a little bit better balanced if you have some in tech, maybe some in healthcare, and those more traditional companies that pay dividends, stated Sun. Thus, attempt to diversify your investment across a range of industries, tech, healthcare, retail, finance, etc., and risk tolerance. For instance, growth stocks have a high potential for both gains and losses. Value equities are more consistent growth. In addition, you can invest in commodities, currencies, and riskier assets like NFTs and cryptocurrencies. These are often more complicated and volatile, so you should properly research them and make sure you are only investing money you can afford to lose. When investing, it's acceptable to seek advice from friends, but you should also perform your research and diversify your holdings. Don't just buy XYZ stock and call it a day if your friend tells you to because it went up for them. For you, it might go down. Having diversity allows you to have wiggle room. While it may seem difficult, investing as a student is a significant step towards financial independence. Starting today will allow you to benefit from compound growth over time, even with little initial investments. By implementing strategic planning, making astute decisions, expanding your portfolio, you may ensure a safe and wealthy future. If you found this story eye-opening, don't forget to like, share, and subscribe for more insights and updates. Hit the bell icon so you never miss a video.